The spread continues to get sort of squeezed out of the syndicated markets. And I don't know if it's because of over-optimism versus, in the levered loan market, it's a CLO-driven market, right? So CLO liabilities have sort of compressed, spreads have compressed there. And so it makes the economics work for CLO managers. So if, a new B2 is pricing at 275, that sort of works for their structures. But for sort of unlevered structures within the business, that I help run, it really doesn't. So, again, not scared, but sort of more of that plain vanilla syndicated risk. We're not nearly as active in this environment as you would expect in sort of a wider spread environment.
Great, thanks.
I would agree. I think it was really the broadly syndicated loans, especially maybe the cohort of single B or even single B below. You're trading how much, I can't even keep track how much of them are trading like at above par, totally driven by demand for CLO paper. I would even say one area where I'm kind of scratching my head is private credit CLO pricing, right? Because that's coming for maybe like 100 bips from its peak, right? So if you look at the private credit CLO and the broadly syndicated CLO tranches, the spread has really tightened. But yeah, I don't understand why it's tightened so much. So I probably won't touch it just yet.
I'll just throw a random one out there. As you think about maturity, and I'm not going to talk about corporates, but you think about all these securitizations that have been done around even single-family rental in the housing sector, as some of these maturities are going to come up and the liability structure resets from, for example, 3% to 5.5% or 6%. What is the actual cap rate on the underlying home? Where people own those homes. I think it's something to watch out for. I'm not really that nervous on credit per se. I think you got to look at the underwriting and if rates are going to stay higher for longer, which is our general view. I think you got to think about there's going to be some tail risk at some point because the unemployment rate is still low, and at some point, if the economy does roll over, I think you got to be a little bit careful around credit.